A $5 billion redevelopment is replacing one of Las Vegas's most iconic properties, and the numbers behind it suggest something deeper is unfolding beneath the surface. Why is this happening now, at a time when the Strip is already facing structural pressure? What is being hidden inside a lease agreement that requires nearly $90 million in annual payments before the new resort even opens? And who is really benefiting from a transition that erased 3,300 jobs in a single day? At the same time, a second risk is emerging. A market shifting away from gambling is now being asked to support one of the largest capital bets in Strip history. This is not just redevelopment, it is a structural test. If you value clear, data-driven analysis, consider subscribing and enabling notifications so you don't miss what comes next. November 22nd, 1989. That was the exact date the Mirage opened on the Las Vegas Strip under Steve Wynn and President Bobby Baldwin. The project cost approximately $630 million, making it one of the most expensive casino developments ever built at the time. But its significance was not just financial. The Mirage introduced a new model, a fully integrated mega resort that combined luxury accommodations, large-scale entertainment, and free public attractions designed to draw mass foot traffic. The Volcano Show, visible directly from Las Vegas Boulevard, became a defining feature. It was not monetized directly, it was a demand generator. The strategy was simple. Attract a broad audience. Convert that audience into gaming revenue. At the time, gaming accounted for the majority of resort income. The Mirage did not need to charge for every experience. Volume compensated for margin. For more than 3 decades, this model shaped the Strip. But by the early 2020s, the environment had changed. Non-gaming revenue began to dominate. According to the Nevada Gaming Control Board, gaming contributed as little as 24% of total Strip revenue in recent reports. At the same time, operating costs increased. Labor, energy, and capital expenditures all moved higher. Then came the structural shift. In 2022, MGM Resorts International agreed to sell the operating rights of the Mirage to Hard Rock International, owned by the Seminole Tribe of Florida, for $1.075 billion. The vision was no longer preservation. It was replacement. By July 17, 2024, the Mirage closed permanently. Within 37 days, the entire structure was demolished. A 35-year asset cycle ended in just over 1 month. And in its place, a new model began to take shape. One that no longer depends on accessibility, but on precision, pricing power, and capital scale. To understand the real pressure behind this project, you have to separate ownership from operations. Because the Mirage was not simply sold. It was restructured. In December 2022, MGM Resorts International transferred the operating rights of the Mirage to Seminole Tribe of Florida for $1.075 billion. But the underlying real estate was not included in that transaction. The land and physical asset are owned by VICI Properties, a real estate investment trust specializing in casino assets across the United States. This creates a split structure. VICI owns the property. Hard Rock operates the business. And the connection between the two is a long-term triple net lease. Under this structure, the operator is responsible for nearly all costs associated with the property. That includes maintenance, insurance, taxes, and most importantly, fixed rent payments. The Mirage lease is estimated at approximately $90 million annually. That obligation exists regardless of performance. It does not adjust downward if revenue declines. It does not pause during construction. And this is where the financial pressure begins to build. Because Hard Rock is not only paying rent on an asset that is currently not generating full revenue, it is also committing an additional $4 to $4.3 billion in redevelopment capital. This creates overlapping layers of obligation. Fixed lease payments, massive capital expenditure, and delayed revenue realization. At the same time, the initial acquisition price implied a valuation of roughly 7 times the Mirage's 2019 adjusted EBITDA of $154 million. For an aging asset scheduled for demolition, that multiple raised concerns among industry analysts. In effect, the operator paid a premium to enter the market, while simultaneously locking itself into long-term fixed costs before the new asset is operational. This is not a flexible structure. It is a leveraged one. And in a market where revenue drivers are shifting away from traditional gaming, that leverage becomes increasingly sensitive to performance assumptions. This is where the model begins to show its constraints. Because once these obligations are in place, they cannot easily be reduced. Only absorbed. To evaluate the risk, you have to look at the most recent performance data available before the shutdown. In 2019, the Mirage generated approximately $154 million in adjusted EBITDA. That figure became a critical benchmark in the 2022 transaction, as it anchored the valuation multiple used in the $1.075 billion operating rights deal. But by the time the property closed on July 17, 2024, the operating environment had already shifted. Post-pandemic recovery brought strong visitor volumes back to Las Vegas. According to the Las Vegas Convention and Visitors Authority, total visitor volume reached over 40 million in 2023, approaching pre-2020 levels. Harry Reid International Airport also reported passenger traffic exceeding 57 million that same year, signaling continued demand for the destination. However, revenue composition had changed. Gaming no longer dominated. Non-gaming segments, rooms, food and beverage, entertainment, accounted for the majority of income across the Strip. This shift increased reliance on pricing power rather than volume alone. For properties like the Mirage, this created a mismatch. The asset was built under a model that prioritized accessibility and gaming-driven revenue. But the modern Strip rewards high-margin, premium experiences. While detailed 2023 segment-level performance for the Mirage was not publicly broken down in full, industry-wide trends indicate that legacy properties were under increasing pressure to compete with newer, higher-end developments. That pressure is reflected in capital decisions. Rather than reposition the asset incrementally, ownership chose full redevelopment. This suggests that the existing performance profile, even within a recovering tourism market, was not aligned with long-term expectations. In other words, the Mirage was still generating revenue, but not at the level required to justify its position on the Strip. And that gap between performance and expectation is what triggered the next phase. Because once revenue is deemed insufficient, the focus shifts from optimization to replacement. At this stage, the financial structure begins to reveal where the real pressure sits. Start with fixed obligations. The lease with VICI Properties requires roughly $90 million in annual rent. This is a triple net lease, meaning the operator also absorbs property taxes, insurance, and maintenance costs. These are not variable expenses. They do not scale down if demand weakens. They remain constant. Now layer in capital expenditure. The redevelopment budget is estimated between $4 billion and $4.3 billion. This is not phased investment. It is front-loaded. Large amounts of capital are committed before the asset begins generating full operational revenue. This creates a timing imbalance. Cash outflows begin immediately. Cash inflows are delayed. And during that gap, the structure carries both construction costs and lease obligations simultaneously. Next is operating leverage. Once the property opens, profitability will depend on maintaining high occupancy rates, strong pricing, and consistent non-gaming revenue performance. With 3,675 rooms and large-scale entertainment infrastructure, even small declines in demand can have disproportionate effects on margins. Because the cost base is fixed. And the break-even threshold is high. Then there is depreciation. A multi-billion-dollar asset depreciates over time, adding accounting pressure that further compresses reported profitability, especially in early operational years. But the most critical pressure point is structural. This entire model assumes stable or growing demand at premium price levels. It assumes visitors will absorb higher room rates, higher fees, and a fully monetized experience. And this is where early signs of stress are already visible. The removal of over 3,000 rooms from the market has increased pricing power across the Strip. At the same time, affordability concerns for both visitors and residents have intensified. Housing costs in Las Vegas have continued to rise, placing additional strain on the local workforce that supports these properties. This is not a future risk. It is a current condition. Higher costs. Higher expectations. Less margin for error. And a financial structure that cannot easily adjust downward once pressure begins to build. To understand whether this structure can hold, you have to look beyond a single property and examine the Strip as a system. Las Vegas is no longer a purely gaming-driven market. According to data from the Las Vegas Convention and Visitors Authority, visitor volume reached over 40 million in 2023, while Harry Reid International Airport handled more than 57 million passengers. Demand, at a headline level, appears strong. But the composition of that demand is changing. The Strip increasingly depends on high-spending visitors, while the local market operates under a different model, driven by repeat customers and lower price sensitivity. This creates a split dynamic between premium Strip properties and off-Strip casinos. At the same time, competition is no longer limited to physical destinations. Online gambling continues to expand across multiple U.S. states, offering convenience and lower-cost alternatives. While it does not fully replicate the Las Vegas experience, it does reduce reliance on physical casino visits for certain segments. Then there is the macro environment. Interest rates remain elevated compared to the pre-2020 period, increasing the cost of capital. Inflation has affected both consumers and operators. Travel, dining, and entertainment expenses have all risen, compressing discretionary spending for middle-income visitors. This creates a narrowing effect. High-income segments remain active. Lower and middle segments face constraints. And that directly impacts a model increasingly dependent on premium pricing. The Strip is adapting by focusing on luxury positioning, large-scale entertainment, and integrated resort ecosystems. But that strategy carries its own risk because it reduces diversification across income groups and increases dependence on a narrower segment of demand. In stable conditions, that can drive strong margins. In volatile conditions, it introduces sensitivity. which means the sustainability of any single project is now tied to the stability of the broader market, not just its own performance. On the surface, everything points to growth. A $4.3 billion redevelopment, a 660-foot landmark tower, expanded capacity, a modernized resort designed to compete at the highest level of the Strip. But beneath that surface, the structure tells a different story. More capital has been committed. More fixed costs have been locked in. And more revenue is required just to sustain the model. At the same time, accessibility has declined. Over 3,300 stable jobs were removed in July 2024, replaced by temporary construction roles and future projections that may not fully materialize until late 2027. Free public attractions have been eliminated. Pricing pressure across the Strip has increased. So the paradox becomes clear. The system is expanding in scale while narrowing in participation. It is generating higher top-line potential while increasing dependence on fewer, higher-spending customers. And that creates a structural imbalance. Because growth, in this case, is not reducing risk. It is concentrating it. Which means any deviation in demand, pricing power, or operating performance carries amplified consequences. Not gradually, but immediately. So the question is no longer whether the guitar-shaped tower will open. It will. The real question is whether the structure behind it can sustain itself over time. Because this project represents more than a redevelopment. It reflects a broader shift in how Las Vegas operates, from volume to precision, from accessibility to pricing power, from diversified demand to concentrated high-margin segments. And that shift is still being tested. If visitor demand remains strong, if pricing holds, and if the new model performs as expected, this becomes the blueprint for the next generation of the Strip. But if demand softens, if pricing resistance increases, or if operating costs continue to rise, the same structure becomes significantly more fragile. This is not a short-term outcome. It is a long-term stress test. And it is already underway. If you want more deep, data-driven breakdowns of how the Las Vegas Strip is evolving beneath the surface, consider subscribing, turning on notifications, and exploring the next video in this series. Because the real story is not what is being built. It is whether the system behind it can hold.